Hello, ladies and gentlemen, and welcome back. Trillions of dollars are set to expire. The market rejected the trend line that realistically stopped every single market rally in its tracks in 2022. And we know that we have a central bank coming out with an incredibly big policy change in less than 24 hours. They're just some of the things that will help you to better understand the market moving forward in today's show. We'll be covering stocks, commodities, and cryptos, the key levels, and everything else that you need to be watching. But there's something even more important than any of those things, and that has to do with money inflows. We've seen the options market show us that retail traders are starting to feel potentially a little bit of FOMO. Is now the time to be cautious? Well, welcome back everybody to the Daily Show. We've got the macro data, the lead indicators, and of course the key levels that you should be watching throughout today's show. We'll also be doing our prize draw at the end, so stick around for that if you were one of the people that entered. So the Dow shed 400 points. Basically, we saw a rally through the start of the session, followed by a swift sell-off. Now, some of that was probably off Goldman Sachs earnings, a little bit disappointing there. Morgan Stanley definitely to the upside. And what we've seen so far with the banks coming out is basically mixed. We're not seeing super strong, we're not seeing super weak, and most are coming in around expectations. But the market is also bought into this earnings season. So as we lead into Netflix, into Tesla, and of course the vast majority of S&P 500 stocks over the next 2 to 3 weeks, we will know a lot more about whether this year is going to be positive or negative. So why are US investors needing to be a little bit careful? Well, it's got to do with the Bank of Japan's meeting. Yes, they're coming out again with a big result, and basically they're going to do some yield curve control. We'll find out exactly how that looks. But in the past, the Bank of Japan has been one of the only central banks in the world, as taken from this thing I shared over on Twitter. Follow at FX Evolution if you haven't already on Twitter. Links in the description down below. And effectively, we can see here that while the US, the UK, Germany have all been showing significant increases in their 10-year yield change, the Bank of Japan didn't. Now, about a month ago, they changed this. They basically said, we're going to stop holding it at 0.25 and we're going to move it to 0.5. Depending on what the Bank of Japan does, this could have dramatic ramifications throughout all markets. Remember, the Japanese people that tend to be great savers. In the past, what they've done is they've saved money and they've sent it overseas into Europe, into the US, and they've invested elsewhere outside of Japan. Now it's becoming more desirable as bonds go up and yields go up there to basically consider investing in their own country. This is going to be a story that is changing for the first time since really even I started my trading career back in 2007 and 8. It's a massive, massive change. And of course, it has ramifications. We're not sure how it'll end up looking yet. We'll need to see what Bank of Japan does come out with, but this is one to watch. We also have had a little bit of interesting inflows. Now, the first thing is we've been discussing this smart money versus dumb money chart, and we crossed the 0.7 into this trend line. Now, previously, we've crossed this 0.7 before during 2022, and it marked disaster for, of course, the stock markets around the world. Basically, what dumb money is it's smaller retail traders and smaller inflows, and that has considerably spiked up in recent weeks as people feel FOMO and think like they need to jump into certain stocks. You can almost see it happening in the markets as well. Some of the best performers in the last 24 hours were Tesla, Nvidia, and of course, squeeze stocks as well. It's clear to me that retail traders are pushing their favorites, and they're some of the ones that have been doing the best over the last couple of sessions. At the same time, smart money or larger money inflow has slowed. It's still purchasing, it's just not purchasing at a faster rate. Something we need to be watching. And as we move forward to options expiration week, you can see here another chart that I've shared. And what this shows us is that in the last 24 hours, huge amounts of calls were opened at the 400 S&P 500 strike. This basically tells us that that level, that 4,000 level, is clearly a point of potential resistance this week. Max pain set to 390. That's where the most amount of puts and calls are as well. And it seems like the market will try to hold, in the perfect scenario, between 390 and 400. Now, that may seem boring, but when you think about it, all of these people down here on the left-hand side with all those puts, as we warned about over the last 3 to 4 weeks, are unfortunately most likely going to lose their money. And this is what you need to watch. You always want to know, where is the open interest? If it's stacked in a certain direction, the odds are more likely to be that the market will remain flat or go against those stacked directions. And the reason, it has to do with money making. And of course, Wall Street likes to make the most amount of money as possible. So let's look at both the bearish and bullish cases moving forward. There are some really strong bullish cases, and we have to talk about them. In the past, you've always looked at certain things. If you have New York Stock Exchange net highs outpacing low percentages, and you're starting to go to something like we've seen recently, which is the most new net highs in over a year. This was taken as of Jan 10th, so it's actually gotten better since then. These types of stats historically have been very interesting to basically prove that you're in either a bullish market or a new bullish market. You're also seeing big changes here in short amount of time, which has to do with thrust and breadth. So we've seen this huge thrust indicator. As you can see here, the average 10 and 20-day ratios of the New York Stock Exchange up down move significantly from the oversold to the overbought. So basically huge thrust changes moving through all of those stocks in the markets. We also know that the S&P 500, when it tends to do this, especially when we combine breadth and thrust, tends to show us that markets are on the rise. Now, I'll put a caveat here. This was one of the lead indicators that many investors used to show that they should be investing in the market and buying basically a portion of their overall investments they had to be in. We have seen this reading in 2022 twice, and in both cases, it didn't really work. It actually happened near the tops of those markets and we sold off. So is the market getting more sneaky with the algorithms and the ability to basically convince us of a certain narrative or a certain inflow? It's possible. Even during 2008, even during the previous times back in the 90s, the 80s, we didn't actually get that many false readings off this. But what was interesting is that 1 week after this reading and 2 weeks after this reading, we did tend to have a pullback. Now, that's actually something that we're expecting right now in the markets, and we'll talk about that later on. But we got a pullback, and then 12 months later, 100% of the time after these readings, at this stage anyway, we were bullish. It's something to keep in mind. Here's all country breadth. So it's not just that it's the US. In fact, the rest of the world is doing way better than the US in terms of investment and movements. When we've had readings like this, like the all country readings, they've tended to be very strong as well. You can see here 2 months later, on average, the market was up 100% of the time. After 12 months, the market was up 86% of the time to an average of 16.8% return. So they're pretty strong returns and they're hard to ignore. So what does this mean for us as retail traders? Should we be then for saying, oh, the bear market's over and the bull market's begun? I think there's 2 key levels we need to look at on the S&P 500. And I do really feel like they're going to be some of the biggest levels, if they're hit during 2023, to think critically about. Here's another one, 10-day total advances versus decline. When we tend to go over 2.1, again, the readings maybe a month later, similar to those other stats. Remember, 1, 2, 3 weeks kind of later was negative. Then all of a sudden it went positive. Look at these levels. I mean, basically there's only one poor result, and that was that 87 flash crash. Generally speaking, again, very strong breadth numbers. Is this the algorithms, or are we needing to actually look at this and say, okay, clearly something is going on here and the markets are truly rallying? Santa Claus rally stacked with the 5-day first trade days of the year, stacked with January returns. Again, if we get a positive January return, we've had negative in the previous year. We know that the year after midterm election years tends to be incredibly bullish, especially if midterms was negative. Will we again see positives? You can say all these data stats, well, this time it's different. I'm just presenting here some information that I think is very helpful, and we have to consider it. And we will consider it, and we're going to consider several levels, I believe, moving forward. Now, at the time of this recording, do we believe that the markets are in a huge rally? Well, yes, they've rallied to a key level that we've talked about, and we had a very key thought process that this would be hit. We're now starting to see, though, greed indicators starting to take over. We've seen that money inflow as people fear missing out. And if we're going to take a step back, is the market cheap or expensive right now? Well, if we use forward PEs as a bit of a expectation and we continue to update this, which I will on this channel, then we're probably expecting, ideally, the market would be at 17. Well, it turns out that's pretty much where it is, 17 forward PE. Is it fairly valued? Possibly, by average. Is it cheap? No. Is it expensive? Not really. It's not super expensive. It's not cheap. But we do need to consider also that things like Citibank and others have said that the new future is going to be lower valuations in general due to economic, I guess you would say, failings throughout the world and also some difficulties out there. So I do think the PE valuations are going to come in and forward PEs might continue to look that bad. It could be that actually the US market won't return like it did over the last decade, and maybe the world markets are the better place to be in. And we will discuss this topic more on the channel moving forward, but do consider forward PEs. We'll continue to update you as we see earnings come out, as we see this type of thing play. But yeah, look, 15, 14, that's the level that most investors want to look at it. Do remember, traders, you don't really care. Whether it's 27, whether it's 14, whether it's 12, all you're looking for is volatility and opportunity. So you don't really care what the value is. Investors will fear missing out. That's the difference. Get your mindset that way. If you're an investor and a trader, then you've got to be able to compartmentalize each one. Buy your investments when you believe it's cheap to do so. Buy when there's fear in the streets. And of course, with the trades, what you're trying to do is just find those opportunities, those statistical advantages. Speaking of trades, what have we had happening over the last couple of weeks? Well, we talked about this a lot. Consumer discretionary, semiconductors, and of course, hyper-style stocks, PBW, solar. So clean energy and solar. They've been the best investments or the best trades. We did pick that flow quite a few days ago. That's continued to be the strongest sectors to be in, and it's been great to be in those recently. Now, we saw a pretty big sell-off in GDX in the last 24 hours. Again, the top performers were pretty much the usual crowd: solar, semiconductors, technology, clean energy. Have we seen the rise of utilities, staples again? Not yet. So until we see that, generally speaking, it's going to be hard pressed to look at the market and say, it looks like the market's bunkering down for a big sell-off. In previous rallies to this trend line, we've generally had a movement into utilities, into staples, into other defensive sectors, and then we've sold off. And that's been quite noticeable. This time around, we didn't quite see that yet, something we will be following up on. Now, what's big ahead? Well, we've got Charles Schwab here, but we also have Netflix coming out on Thursday. So I think Thursday's earnings is going to be the big one, the beginning of tech. Then in the next week, the 25th, is Tesla. That's going to be a big one to look at. And as we move forward past January, we start to go into the Amazons, the Microsofts, and all of those other big ones. So these are going to be some of the important earnings moving forward. We need to be able to be on top of all of these. And of course, we'll be following them here on the channel. So just before we jump into the charts and we take a look at every key level that you need to be watching in the markets right now, I want to say a big thank you to Tiger Brokers, who are sponsoring today's video. As we know, they're offering a whole bunch of specials to everyone that's eligible around the world. Links in the description down below. But for the ASX, for the Australian viewers, 90 days of free brokerage if you sign up and fund with as little as 1 cent for US and ASX trading stocks. Free in-depth market data. That's important for the Australians out there. 5 fractional shares totaling USD 50. Looks like you could potentially get a little bit of Buffett as well, which would be kind of nice. And you also get, as an FX Evolution community member, 1 additional ANZ stock. But it doesn't just end there. But before we go through the extra thing that we've added in with Tiger Brokers, I did want to talk about their platform, specifically into earnings throughout the US and, of course, Australia. You need to have headlines. Remember, we do want to know the news. We want to be able to pull it apart. The great news is Tiger Trade have also got some premium feeds in here. You'll notice things like Reuters, Motley Fool Seeking Alpha, and a whole bunch of others are shared. These headlines are timely. They come out. You can put them in the platform and have them there. But one of my favorites is always going to be the investing calendar. This ability to be able to select the markets that you're interested in, the ability for you to be able to select possibly just report announcements for now and then dividends. And one of my favorites has to be this, which is of course to be able to select either positions you're in or watch lists and see the news coming out for that particular stock. Switch between monthly, weekly, and daily. It's a great thing to have. And as you can see here, these are all the stocks coming out in the next 24 hours for the US. It's great to have a broker that offers this stuff inside the platform. Some do. I'm sure you do have one that may do it, but most don't. And Tiger Brokers are always improving their platform, which is really fantastic. Now, during the month of course, the Chinese New Year, which is this month, and also during the start of Western New Year, we are giving a little bit of an extra promotional giveaway. For anyone that signs up and funds with as little as 1 cent, you go into the prize draw to win one of 4 great courses that, of course, we offer over at fxevolution.com. And we've partnered up with Tiger Brokers for this. Look at the description link down below. But you know what? If you go in it, you've got to be in it to win it. Yeah, there's no harm in giving Tiger Brokers a shot. Try them out. Check out the description down below and see whether you're in one of the eligible countries. Thanks so much. Let's get into the charts. Okay, well, we'll begin off here with the JP10Y. This is the chart that everyone will be watching in terms of investment bankers, hedge funds, and of course, the biggest players in the world. Why? Because what happens here should have dramatic ramifications, not only for the US dollar yen, but also potentially currency traders and stock traders. Now, we've seen a lot of pressure being put on the JP10Y. Obviously, expectations are that they'll probably raise and they'll come out and effectively this will move up. Now, you can already see the pressure being put on this. Effectively, this is an absolute catastrophe, in my opinion, what the Bank of Japan has allowed to happen. But we will see some volatility on these pairs, so make sure to be careful of it. We'll talk about it after we see the result, and we'll do an in-depth on it in the next 24 hours. Let's move over to the US markets and the rest of the world, and we'll talk about the VIX to start off with here. The VIX is, of course, the volatility indicator. Now, I think during most years, the VIX hits on average 33. I think that's the number. The VIX has been around for around 30 plus years. So if most years we get a VIX 33 reading, the question then becomes in which quarter? Historically, it's been Q1 and Q3 that we've usually seen those types of readings come out from the VIX. And as we know, we're historically low. Fear has literally gone out of the market. And part of this is to do with that realistically, the market is unable to go down in some ways due to what's happening with the options and how much expiration we have in only a few days. Let's now move over to financials. I wanted to bring this forward in today's show, and the reason why was simple. We're at an absolute critical level. We saw Citi, we had Wells Fargo, JP Morgan. Now we've seen Goldman Sachs, usually a pretty good performer, underperform the market expectations, and Morgan Stanley overperform. Financials are on the teetering top of this resistance. And I think this is a level that you will want to watch and understand what happens around here. I'm going to set a little alert just in case it breaks out, because I do think that if the markets are breaking out with financials, there could be more to come. And that's something that's fairly interesting. You know, that 38 could be the next target. At this point, we're at the resistance and we're at a very interesting potential turnaround for financials to go back down. Let's take a look at Morgan Stanley. You can see here it gapped up. It was pretty excited about everything and actually broke out. On the flip side, if we look at Goldman Sachs and we bring that on the chart, it sold off fairly heavily. It was down 6.44% on the day. And this had been a stronger stock moving forward. And then all of a sudden it came down and it's back down to that level. Is that an overreaction? Next 24 hours will tell us a lot about these banks. But Goldman Sachs certainly did not report the way the market wished it to. US 2-year, that's been holding steady. Not too much moves on yields. Potentially the Bank of Japan will switch this situation slightly. But in general, we're sitting at a very critical potential support here. And if the market breaks through that, well, that's just basically showing us that the market's believing that there's going to be more rate cuts in the future and possibly a lower terminal rate for the Fed. At the moment, the Fed's saying 5.1%. The market's saying, we call your bluff there, Fed. We believe you can't get past 4.8. So there's a bit of a crisis here in the markets. The markets don't believe the Fed will push as high. The Fed's saying we will. This is going to come to a conclusion over the next couple of months for sure. Let's move over to the DXY. This is the one to be watching. I think this is the chart of the week, actually, the US dollar. So there's a few reasons why. First up, I wanted to mention this is a weekly and a monthly low level that we reached the other day. We've since bounced off that zone a few times. Take a look at this daily and have a look at the way the wicks are rejecting. We've got a long leg doji, a rejection wick, and then a long leg doji. What's that telling us? The market's at equilibrium, and effectively it's at a very happy point ahead of the Bank of Japan and ahead of course, major earnings, debt ceiling, all these other types of things that are coming forward. Now, I wanted to mention with the debt ceiling, don't read into it too much at this stage. It's not a bit of news that you can figure out exactly what the market is doing, but I will say this. The general perception will be that the US dollar should get crushed because of the debt ceiling. The US dollar already has been crushed in recent months. So considering we've now got some buying wicks, this is a very critical level. It could still be distribution with the drop off. I'm going to set alerts both sides. So we'll set an alert for a new low, but I'm very open to either being bullish or bearish here. And even with the weekly, I think a lot of people are probably talking about how the US dollar is going to go falling down. I will say this also. In the last 24 hours, we've seen a net closing of shorts on the euro. So that means that everybody's been betting basically with the weakness, or basically betting against the euro and against a strong dollar. They've become convinced the strong dollar doesn't exist. And funny where that's happening, yeah? So this is what retail traders are doing. Retail traders are literally closing their positions. They've suddenly become convinced that the US dollar is dead and that the euro is going to become even stronger. Well, wait a second here. We've got this 102.67 area. This is something we brought up on the weekend video. We've now come down. We've tested this zone. We saw a pretty strong buy. This is super important. I want to know what happens next. If we get up to 103.20, I wouldn't blame people trying to short there, okay? So I'm thinking like something like this is probably what's going to occur. And if we breach past this 103 kind of 52, this is going to be critical for strength in the US dollar. So these are the levels. I'd be looking for potentially into here. Short definitely is a possibility in here. If we end up busting through this zone, 103 kind of 70, 103.50, then pullback should be met by buy demand. And I actually favor at this point, if this is broken, weakness into strength for the US dollar. So very, very critical point. Let's have a look now at some of the other things that are happening. First up, gold. We don't have a sign that gold's weak yet. Yes, it's been falling in the last couple of sessions, but we haven't even broken under the last demand zone yet, the last swing. So we've been going basically from new peaks to new higher kind of troughs, to new higher troughs, to new higher peaks. We haven't broken to a new lower low yet. This is a critical level. I'm going to put it on the chart right now for you guys. So it's 1895. Anything in that area is where you expect buyers to recommit. And if you're feeling bullish on gold still, that's going to be an important one. I'd expect it to be put under pressure in the next 24 hours, most likely due to something to do with the Bank of Japan. We'll find out. This is, critical point. Next critical point will be 1870, like we discussed before, where we went bullish and we thought it was going to keep going. There's no real signs, though, at this stage. Remember, January was expected to be a very strong month for gold. It is seasonality. February can be a bit more neutral to down, and so can March. So I think we've got to remember those dates as well in our minds. Let's move over to the US oil story. This is going to be a big monthly close. Big rejection wick, and of course the monthly where it sits. I've talked a lot about 65 being a level for me. With oil, I've said it since 120, I've said it since 110, I've said it since 90, and we hit one of the first targets, which was 75, and then we got down to 70. This does look like an accumulation base though, and I think a lot of it has to do with China's reopening story. We're at a critical point. If we breach through here and then get through that 82, next target's probably about 93, 90 or 90 for oil, and I could see it coming up a little bit more. Is 65 gone? Well, the China reopening story, I think, is a big one. Clearly, they're telling and they're demonstrating to the world they're in trouble. They're trying to kickstart their own economy as people deglobalize. The world deglobalizes in some cases. And we've seen how headstrong the government can be into a narrative and holding true. The lockdown, then suddenly the pivot. That pivot, once they start, they tend to go for quite some time with an idea. And I do think that they're trying to build confidence back in, relaxing lending and property, all these types of things. So could oil continue to pick up? It's something that I've discussed ever since we broke this 77. I've kind of been more bullish on it. And I have an inkling that it will actually go up off this point. But it's a guess. And at this stage, the technicals basically don't really lie. I mean, those monthlies are huge. And if we get another monthly close like this, even any pullback you'd have to think is met by buy demand. Clearly, someone is purchasing down here, and it's probably a bigger player. Let's move over to Tesla. Tesla hit that 130 target that we had. I still think this is probably a critical zone for Tesla. There's no technicals here. We can see the expected options for the end of the week have changed. 137 on the top end, which is funnily enough a gap fill. And then the bottom end is 125. It's expected to stay within those boundaries 68% of the time. But as we know, it's very volatile. And what happened over the last 24 hours was someone went crazy and bought a bunch of 200 strike calls. Yeah, they went crazy. I don't know what they're doing. I'm assuming they're going to close them before Friday and they're just trying to get the market up. But you'll notice here those 130 calls started, rising quite a lot. We've now got 140s, 150s. There's a bit of a squeeze going on here from Tesla. Is this the beginning of a new rally? It's probably more of an oversold into squeeze. We've reported on that a lot here on the channel. We were never a believer that this thing would get under 100. There was too many puts and too much negativity. Everyone stacked in. Yeah, it's time for that dead cat bounce, or at least that kind of narrative up to there. Oh, do I like it now? It's hit 130. Probably not. And the reason why is because in here, you're starting to feel that calls probably coming through. That was a very strong session. I would be surprised if it can get past 140 this week. And I think that the upside is probably like 10. The downside is maybe 10 to 15. So you're starting to work in that 50-50. Congrats if someone took it into the 130 area. Very critical zone. Watch what happens on the options moving forward. It's going to be a critical level. Let's move over to Apple. At resistance, you can see a little bit of a rejection coming through. Supports, supply, resistance. This is critical level, funnily enough, happening when we hit critical zones for stocks around the world. As we talked about, consumer discretionary has been absolutely kicking the ass of staples, and it's continued to do so. It's been risk on, risk on, risk on across the last couple of sessions. And it's really been like that for 2023. We first reported on this a little while ago. We broke that downward trend line. And since then, we've had some amazing consumer discretionary days. Well, it's continued. But guess what? We've just hit a critical level. So within that next little bit of a pickup, it's why, I'm a bit cautious here on Tesla as well, because it is a consumer discretionary. We've hit that kind of big potential turn here for staples to start to outperform discretionary. Critical level for traders to be watching in the next 24 to 48 hours. What about the smaller caps? Well, smaller caps have had amazing runs on them. They've hit that critical level again, consolidating in here and doing a little bit of, you would say, I guess, just basically relaxing after a very, very large move. Yep, we're at that key point where we've seen daily closes before. Anywhere around here could be where it tips over. That was a big run. If we take it to a percentage from this section here to where we are at 7.74, pretty significant, and certainly showing us that smaller caps have been where it's at. In particular, things like RK, of course, huge runs on that, getting closer to that resistance, again, 38, very similar to some of the other things we've seen. This is a critical level. We're moving into it. And hyper stocks and FOMO style stocks that retail traders love, this is the quintessential version of that. Effectively a bunch of really, really high PE stocks all running at once that retail traders tend to like. Well, it reminds me of some of the other times we've rallied. And if you actually overlay an SPX onto this chart, what you'll notice is that we do tend to see those kind of peaking rallies near the ends of some of these bullish runs. This one here wasn't quite like that, but we're getting it now with this exceptional run in ARK. And that's what really defined 2022. When we saw rallies in retail style stocks, bad things tended to happen after that. Will that happen again? Time will tell. We do have breadth and thrust, but again, we even had that some of the times in 2022. What about the FTSE? Well, this is one of the most shorted CFD markets in the world. That's futures markets for anyone that's in the US. Basically, what's occurring here is retail traders have been trying to short the FTSE, the France 40, and of course the DAX more so than anything else. It was upwards of 90+% short. And why do I bring that up? Because when you tend to get so many people shorting, what that usually has meant is that people have, the spread of the short concept has come, full circle. It's gone all the way, but also so many people have been squeezed. And I would think that the FTSE is not only is it approaching all-time highs, but it's really close to that point where you could see it switch over, because in the last couple of sessions, what's happened is we've seen a little bit of shorts being reduced. Why? I believe they've been squeezed and basically their profits have been evaporated and turned into massive losses. And this is what tends to happen. We get a squeeze, it punishes as many retail traders as possible, and then suddenly it turns the story. Now imagine this just for a second. As you can see, this looks like a huge breakout. What if it falls off here, breaks under this level? What are you going to start thinking of? Let's see if anyone can put it in the comments down below. I'll give you a couple of seconds here. Pause the video. And of course, yes, if you would put in Wyckoff, you would have been correct. It could be a Wyckoff distribution. I'm not going to call it yet because we haven't seen enough. But if we do get a breach underneath here, we have to start thinking, wow, this could be really big. I'm going to watch the FTSE quite a lot in coming months if we do get a sell-off in this location. US100, you can see that steepening kind of trend line. We also almost hit that 61.8 of the full retrace on the futures market. You can see that with the downward trend. And we're at a fairly critical level. Now, what do we need to look for in the next 24 hours? Well, I'm going to be looking for a new low to be actually formed. So I probably want something like this 11,463. We've got a high obviously in here. We've got kind of like a low area. We've got a higher high. This would be the first signal that something's going wrong. This signal in here would be that, okay, cool. It looks like we're going to go short for a little period of time. This was a nice rejection. However, we don't have follow through yet on these markets. We don't know that this is absolutely going to sell. We're just guessing because of what we've seen with the options. We do have a gap fill on the S&P 500, 39.18. We do have a rejection wick. For buyers, you know what you want. New high. New high comes now. I feel pretty strongly about the 41.13 kind of gap being filled at that point. So I'm going to set an alert here for a new high should it come. That's above 40.20. Let's set an alert above there. And it is critical. 61.8 fib retracement, 200-day SMA, downward trend line. All of our lines clearly make a lot of sense because otherwise you wouldn't have seen a rejection here. We had 4 days up. We finally had a day theoretically down, although it wasn't that big. And we do know that 400 calls were opened pretty strongly. So that's something that's certainly stuff to watch. We do want to get that 39.18 gap fill. Will it be now? It actually makes perfect sense to the futures market. Let's have a look at what's going on with the expected range of the market. No higher than 402 or 393, 68% of the time, according to the options market. Interesting, something to be watching. And if we look at the last 24 hours, this is actually what happened. We saw the market effectively rally to the previous daily level and then sell off from that zone and then come down into this demand level. So I wouldn't be surprised at all for the market to potentially recover back to being flat again. And if we see a sell-off, or even if we see something like this in the next little bit, then I'm looking for a bit of a retracement, ideally. So I actually wouldn't mind it just to go like this, retrace, and then short off down to 39.40 being first target, 39.20 being kind of the second target. It is critical level here. And as you can see at the time of this recording, it's holding its own at that zone. If we make a new high past 40.16, I think what we've seen over the last 24 hours is we will push. And where can we push to? Well, let's have a look at the options. This is the latest charts. As we know, technically it's best for them to close it at 390 at this stage, 5.2 million units. That's a ton of units out there. But most likely we're moving towards, at that stage, you would think that 410 to 415. That's where the next call walls would be. So if we get a break past that 417, we should, or 420, we should be looking at realistically moving forward. And I will apologize there. I've got 402. I keep saying 420, but yeah, it's 402 on the option strike. So if we get past 402 on the option strike, then we should move up to 410 or even 415 for the week. This is a very tough location. It's not going to be easy. The best thing for the options would be to drop, then rally forward, and probably end in the middle. And even though Max Payne's at 390, I think anywhere in here would be A-okay with Wall Street. Definitely a key zone. Let's move forward to Bitcoin and crypto. Did it hit a critical level? Well, of the previous full decline, it's now come back to the 61.8. I did have this other zone around that 19, 20K, and I thought that it might stop there. There was absolutely no signs of sell-off at that zone. And as I said, if the market went through there, 21K seemed incredibly likely into this area. That's where we've reached. This is absolute critical. So what do we find ourselves in? Critical US dollar, critical S&P 500, critically overshort, like heavy shorts on a whole bunch of European indices, and cryptos at resistance. So markets are all precipice to either do something that's going to freak everyone out, and we keep rallying up to the first level, maybe 41.10, 41.50 as we saw, and freaking people into a FOMO style position. AMC, Triple BY, all of these things are running rampant. And this is usually consistent. Remember, Tesla, Nvidia, so many retail traders stocks have been some of the breakaways in the last couple of days of trade. And I think that really points towards retail traders being suckered in. Maybe it is literally that dumb money is making a mistake here. Time will tell. We're critical levels. We know our key zones. Good luck out there, and obviously practice your own risk management and come up with your own conclusions. What are we talking about in terms of big news? We've got tentative Bank of Japan press conference. I can tell you the Australian time. Generally, it's around 2:30 p.m. Australian Eastern Domestic Time, even though it says tentative. Somewhere between 2 and 4 has historically been, this is Australian Eastern Domestic Time, has historically been where it comes out. As we move forward, we've got core PPI coming in Wednesday, 8:30 a.m. Maybe that's the catalyst to take us somewhere. We've got retail sales and core retail sales, of course, coming up. And then we move forward Thursday and Friday. It's earnings, it's debt ceiling, it's Bank of Japan, it's core retail sales. So much to throw at these markets. Super critical level. Practice risk management, guys. If you're unsure, guess what? There's always another opportunity for you to take advantage of. Do remember as well, if you haven't already, subscribe, smash that like button, and consider checking out the sponsor of today's video stuff down below. Link in the description for all of the special offers. Okay, well, it's that time again for us to draw the prizes. And as we know, there are 4 major prizes here. We'll draw the 4th prize first, 3rd, 2nd, and 1st. Good luck to each and every one of you out there. Let's now draw them. We've put everyone's numbers in. I think we have over 2,000 entrants, so thanks so much. And good luck to the people that are going to be winning. So for the 4th prize, we've got Benedict Mendigoran. I hope I didn't butcher your name too much. Congratulations for winning the Ultimate Trading Masterclass. Let's now pick another name. We'll start again. That will have removed that person, by the way, to make it fair. We've got Dan K. We'll be in contact with you soon, Dan. Congratulations on winning the Advanced Scalping Masterclass. And then we've got for the options, Jackie Setso. Congratulations. I hope you enjoy that course. And of course, we'll be in contact with you in the next 24 to 48 hours with your prize. And to win the big group mentoring with me, it's going to be Yi Kai Lin. Look forward to meeting with you in February. So thanks so much for everyone that entered. Thank you for supporting the channel. And as always, this is just a little bit of us giving back to members of the community. Totally free to enter. So we'll be doing it again, I'm sure, very soon. Thanks so much. And I look forward to meeting Yi Kai very, very soon in the February group mentoring.